Picture this. You're driving to work, you're already running late, and that little check engine light pops on like it owns the dashboard. Your stomach drops because you know what a normal person does next. They pull into a shop, they pay maybe a few $100, and they move on with life. But you open your bank app, and you've got $40-something until Friday, so you do the only thing you can do. You turn the music up, you tell yourself it's probably fine, and you pray. Then the math shows up. Not school math. Life math. 2 months later, the car dies on the highway. Now you need a tow. Now the cheap fix became a big fix. The math of being broke is brutal because being broke isn't just having less money. It's being forced to buy everything on the most expensive payment plan imaginable. Hey, I'm Dylan from Dylan Investments. Money talks, and I translate it for you. And the first translation today is simple. When you're short on cash, you're not just poor. You're expensive. Here's where it gets interesting. Most people think the broke tax is just fees. Like, yeah, overdraft fees are annoying. But the real cost is bigger. The real cost is that when you don't have slack in your system, every small problem becomes an emergency. And emergencies are the most overpriced products on earth. Same service, same item, same repair, same life, just purchased under time pressure. That's the difference between buying a battery at Costco on a Saturday and buying a battery at a gas station at midnight on the side of the road. The battery isn't magically better at midnight. You're just paying extra because you have no options. So let's define the enemy in plain English. Being broke means you're living with zero shock absorbers. No cushion, no buffer, no margin. And margin is what turns surprises into inconveniences instead of disasters. When margin is gone, life charges you rush pricing for everything. Banks charge you for being a day early or a day late. Landlords charge you for being a week short. Credit cards charge you for needing time. Car problems charge you for not being able to handle them when they're still small. Even your job charges you because being broke makes you less flexible, less able to say no, less able to walk away. Let me make it less abstract. I know a guy, we'll call him Alex. Alex wasn't irresponsible. He wasn't out here buying yachts. He was doing the classic American thing. Working, paying rent, trying to keep his head above water. The problem was timing. Payday hit on Friday, rent was due on the 1st, and his bills were scattered like confetti. 1 month, his phone bill hit a day early. That pulled his checking account low enough that a grocery run triggered an overdraft. Then the bank hit him with a fee. Then, because the fee posted, another payment bounced. Another fee. He got hit twice for the crime of being out of sync. And the wild part is, the bank didn't need him to be broke. The bank just needed him to be close enough to broke that timing could knock him over. That's a huge piece of the math. When you're broke, you're not paying for stuff. You're paying for timing. And timing fees are savage because they stack. A $35 overdraft doesn't look like much until you realize what it actually is. If you overdraft by $10 and the fee is $35, that's a 350% penalty for being $10 short for a couple hours. Show me a business in America with margins like that. It's not a margin. It's a trap. Now, before we go any deeper, I want you to notice something. This system is designed around the assumption that you have a cushion. Autopay assumes you have extra. Late fees assume you can float it. Credit scores assume you can consistently hit due dates. Even the cheapest options in life assume you can pay up front. And if you can't, you don't just pay more. You get pushed into the expensive aisle of everything. Let's talk about debt, because this is where paying double becomes literal. A lot of people use debt like a bridge. They're not trying to be reckless. They're trying to survive a gap. The problem is the price of the bridge. If you're using a credit card at 20-something% interest, you're renting money at a premium. And renting money is fine if you rent it for a minute and then return it. But if you're carrying balances because you're always recovering from the last emergency, the interest isn't just a fee. It becomes your new permanent bill. It's like you added another subscription to your life, except this subscription doesn't give you Netflix. It gives you the privilege of still being stressed. Here's the part most people never see. Interest isn't really the punishment. Interest is the price of risk. If a lender thinks you might not pay them back, they charge more. That means the people who can least afford expensive money are the ones who get offered expensive money. And then we act surprised when that expensive money keeps them trapped. It's like throwing someone a life jacket and charging them rent for it while they're still in the water. And it's not just credit cards. It's the payday loan world, the cash advance world, the buy now, pay later world when it turns into late fees, the rent-to-own world, the subprime auto loan world. The names change, the math doesn't. When you don't have savings, you're forced to finance problems. When you're forced to finance problems, the interest becomes a second problem. And when the second problem grows, it creates a third problem, which is missed payments, which creates a fourth problem, which is a damaged credit profile, which makes future money even more expensive. That's the loop. Remember that moment at the beginning with the check engine light and the bank app? This is the exact mechanism behind that feeling. The stress isn't just emotional. The stress is your brain correctly recognizing that every surprise will be purchased at emergency pricing because you don't have the luxury of normal pricing. Now let's talk about something that sounds small, but it's a massive wealth divider. Paying upfront versus paying over time. Rich people aren't rich because they never face costs. They're rich because they can pay for costs in the cheapest format. They buy the annual plan. They buy the bulk size. They do preventative maintenance. They replace the tires before they're bald. They go to the dentist before it's a root canal. They can pay a higher deductible and get a cheaper monthly insurance premium because they can actually handle the deductible if something happens. When you're broke, you get forced into the opposite strategy. You buy the smallest size because it fits in today's budget, even if it's a worse price per unit. You skip maintenance because you need this week to work. You pick the low deductible plan because you can't risk a big bill, even if the monthly cost is higher. You pay monthly because you can't pay yearly. And month-to-month pricing is basically the economy saying, we charge extra if you can't commit. Let's make it painfully real with groceries. If you can buy in bulk, you're buying cheaper calories. If you can't, you're buying the convenience premium. And the convenience premium isn't a moral failure. It's a cash flow reality. When you have $100 to feed yourself for the week, you buy what you can carry home, what you can cook quickly, what won't spoil, what fits the moment. Meanwhile, someone with margin can stock up when prices are good, freeze food, plan meals, and avoid that, oh no, I need dinner right now panic purchase. Same human body, different math. Housing does this too. If you have cash and strong credit, you get options. If you don't, you get requirements. Security deposits. First and last month. Application fees that stack even if you don't get the apartment. Higher interest rates if you buy. More expensive insurance. And if you're renting and your landlord hits you with a surprise increase, you might not have the buffer to move, even if moving would be smarter long-term. So you pay the higher rent. Not because you want to, because you can't afford the cost of changing your situation. This is where things quietly go wrong. People confuse a lack of intelligence with a lack of options. A lot of broke people are doing brilliant financial gymnastics every month. They're juggling due dates, negotiating time, stretching food, delaying bills, choosing which fires to put out first. That takes skill. The tragedy is that the skill is being used to survive, not to build. And the system profits from that survival mode. Let me give you another quick story. I have a friend, we'll call him Mike. Mike had a job, but the hours were inconsistent. One month, his car needed a repair and he didn't have the cash. He took a short-term loan because he needed to get to work. The loan fixed the immediate problem, but the repayment hit his next paycheck like a wrecking ball. Now he was short again, so he took another advance to cover the gap. Now he was paying fees to borrow his own future income. That's the dark comedy of it. You're renting your next paycheck before it even arrives. And if you've ever been in that spot, I don't need to scare you with statistics. You already know the feeling. You already know what it does to your sleep. You already know how it makes every day feel like a countdown timer. And the countdown timer is expensive because it makes you choose speed over strategy. Now, there's a bigger layer here that a lot of people miss. Being broke isn't just expensive because of fees and interest. It's expensive because it steals your time. Time is money in the most literal way. If you don't have cash, you spend time hunting for cheaper options, calling customer service, waiting on hold, taking buses, doing paperwork, fixing problems that could have been avoided with a little margin. That time cost is invisible, but it's real. 2 extra hours a week dealing with money chaos doesn't show up on a statement, but it changes your life. It makes you more tired. It makes you more likely to make short-term decisions. It makes you less able to build skills, apply for better jobs, or even rest enough to function at your best. Here's the twist. The world often sells financial advice as if the main goal is to optimize. Like you're already stable, and now we're choosing between 2 credit cards with cute reward categories. That's not the game for most people. The real game is getting out of fragility. Not perfect, Not rich, just not fragile. Because when you're not fragile, your costs drop, your options expand, your stress goes down, and you stop paying double. So what does not fragile actually mean at your kitchen table? It means you have a buffer, even a small one, that breaks the chain reaction. If you only remember one idea from this video, make it this one. Your first financial goal is not investing. It's not a perfect budget. It's not even paying off everything. It's building a tiny wall between you and randomness. Because randomness is what's been extracting fees from you. I'm going to say something that might sound too simple, but it's the most practical thing I know. If you're stuck in the broke math, your first win is stopping the bleeding. That means you hunt down the penalties that are hitting you repeatedly and you design your life to avoid them, even if you don't feel ready. If overdraft fees are a recurring villain, you switch banks or accounts to one that doesn't treat you like a piñata. If late fees are a recurring villain, you set auto-pay for the minimum on anything that charges late fees, not because minimum payments are ideal, but because the late fee plus credit damage is worse. If subscriptions are silently draining you, you pause them, not forever, just until your money stops free-falling every month. This is where people get stuck emotionally. They think, if I set auto-pay for the minimum, I'm admitting defeat. No, you're buying stability. You're putting guardrails up so your future self stops getting ambushed. Guardrails aren't the destination. Guardrails are how you keep the car on the road while you drive somewhere better. Next, you build what I call a stupid small emergency fund. I don't care if it's $100. I don't care if it's 200. The first goal is not a magical number. The first goal is proof. Proof that you can hold money without it instantly evaporating. Proof that the next minor surprise doesn't instantly become debt. Proof that you can create even a tiny gap between income and spending. That gap is oxygen. And I know what you're thinking. Dylan, I can't save. Everything is already spoken for. I hear you. So don't start by saving a lot. Start by saving something consistent and automatic, even if it's laughably small. Because the point at the beginning isn't the amount. The point is building the muscle and building the system. One automatic transfer a week, right after payday, to a separate savings bucket you don't touch. You're not trying to become a hero. You're trying to become less vulnerable. Here's where it gets weird in a good way. Once you have even a small buffer, your entire financial life starts to get cheaper. Not because you got a raise yet, because you stop triggering the expensive outcomes. You stop overdrafting. You stop paying late fees. You stop needing the emergency version of everything. It's like when you stop running late, your whole day improves. Same schedule, different experience. Now let's talk about high-interest debt, because this is the other major paying double machine. If you have a credit card balance that's been hanging around, I want you to reframe it. It's not just debt. It's a tax you pay every month for past emergencies. And once you see it that way, you treat it like a leak. You don't need a fancy plan to start. You need a rule. Any extra dollar you can reliably send goes to the highest interest rate debt first, while you keep that tiny buffer intact so you don't have to swipe again the next time life sneezes. And if you're thinking, but I don't have extra dollars, then the mission becomes creating a little space. Not by turning your life into misery, but by finding the expenses that don't protect you and cutting those first. People cut the wrong stuff. They cut the things that keep them functioning, like decent groceries, and then they burn out and rebound spend. The better move is cutting the stuff that's quietly expensive because it doesn't actually improve your life. Fees, penalties, convenience habits you don't even enjoy, purchases you make just to feel less stressed for 10 minutes. This is also the moment where I'm going to give you permission to negotiate. Because a lot of the broke tax is negotiable, but nobody tells you. You can call and ask for a late fee waiver if you have a decent history. You can ask for an interest rate reduction on a card. You can ask your internet provider for a better rate. You can shop insurance. You can ask about hardship programs if you're dealing with medical bills. You can set payment plans that don't explode your month. This isn't begging. This is playing the game that already exists. Let me give you a quick example with a simple mindset shift. There are two kinds of bills. Bills that punish you for being late and bills that don't. Rent and credit cards punish you. A lot. Utilities can punish you, depending on the company. Some other bills are more flexible. If you're in survival mode, you prioritize the ones that create cascading damage. Not because the other bills don't matter, but because your goal is to reduce chain reactions. You're not trying to be morally perfect with money. You're trying to stop the avalanche. Remember the check engine light? Here's the clean lesson. Preventative maintenance is cheaper than repairs, but preventative maintenance requires margin. So if you can't afford preventative maintenance, your real target isn't be more responsible. Your target is build margin. Even $50 a month into a car repair fund changes your life over a year. Not because it guarantees nothing breaks, but because it keeps a small issue from becoming a financial car crash. And yes, income matters. I'm not going to pretend this is all budgeting. You can be disciplined and still be underpaid. But even with income, margin is the unlock. Two people can make the same salary and live in totally different financial universes depending on whether they have a cushion. So if you're trying to climb out, think in layers. You stabilize the floor first, then you build the walls, then you build the roof. Stabilizing the floor is eliminating repeat fees and building a starter buffer. Building the walls is paying down high-interest debt and smoothing your cash flow. Building the roof is increasing income, getting benefits, and investing consistently so you're not always one surprise away from falling back through the floor. Here's a little playbook I'd use if I were sitting at your table and we were doing this together. I'd start by making sure your money stops getting fined for existing. I'd set alerts on your bank account so you know when you're low before the bank knows. I'd make due dates less chaotic, sometimes by changing them, sometimes by building a simple calendar habit. I'd automate the minimum payments so late fees stop stacking. I'd switch away from the most predatory accounts and products I can realistically switch away from. Then I'd build that small buffer in a separate place that's slightly annoying to touch. Not impossible, just annoying. And once the buffer exists, I'd attack the highest interest debt like it insulted your family. If you do only that, you'll feel something most people don't feel for a long time. You'll feel quiet. Not rich. Quiet. The kind of quiet where you can get a flat tire without it turning into a life crisis. The kind of quiet where you can open your bank app without bracing for impact. And when you get that quiet, I want you to notice the last piece of the pay double math. Opportunity cost. This is the money you don't see because it never happened. When you're broke, you miss chances. You miss the cheap flight because you couldn't book early. You miss the job opportunity because you couldn't take a week between jobs. You miss investing during a dip because you're just trying to pay rent. You miss the side hustle upgrade because you can't buy the tool up front. None of those show up as a fee, but they're real costs. And they're the reason people feel like they're working hard and still not moving. This is why I'm not here to shame you. I'm here to explain the machine. Because once you see the machine, you stop blaming yourself for every symptom and you start aiming at the actual leverage points. The leverage points aren't sexy. They're boring. They're the unglamorous systems that keep you from getting charged extra for being human. So if you're watching this and you're in that season where everything feels tight, I want you to take one thing from me. Your goal is not perfection. Your goal is space. Space between you and the next surprise. Space between your bills and your paycheck. Space between your impulses and your actions. And every time you create space, you stop paying the emergency price. If this clicked for you, save this video. Not because it's motivational. Because the next time your car makes a weird noise, or your landlord sends an email, or your bank balance looks disrespectful, you're going to need a reminder that you're not crazy. You're experiencing a real financial physics problem. And physics problems can be engineered around. And if you want the next logical step after this, it's understanding how to build a budget that actually works when your income is inconsistent, because that's where a lot of people get wrecked even when they're trying. That's a whole other translation, and it matters. For now, I want you to walk away with a new sentence in your head. Being broke is expensive, but it's not permanent math. You can change the inputs. You can reduce the penalties. You can build the buffer. You can make your life stop charging you rush fees for existing. And when that happens, you don't just save money. You get your brain back. I'm Dylan from Dylan Investments. Money talks, and I'll keep translating it for you. Have a good one, my friend.